Hey there, and welcome back. Today, we're going to show you how to spot support and resistance levels on a candlestick chart using price action techniques. If you're interested in more ways to identify key levels, let us know in the comments, and we'll cover them in future videos. First, let's quickly go over three types of trades at support and resistance levels for beginners. Reversal trades involve a change in the current trend direction. Generally, it's not recommended to rush into a trade at a reversal. After all, as the saying goes, one candle doesn't reverse a trend. It's better to wait for the price to form a high and possibly make a higher low and a pullback. Breakout trades happen when support or resistance levels fail, and the trade is entered as the price breaks through. Traders typically wait for a long, strong, and high-volume candle that breaks the level almost like it wasn't there at all. The third type is the flip trade, where the price breaks a level and then comes back to retest it from the other side. In this case, traders usually wait for a candle to fully form below or above the broken level, confirming the retest. This helps improve the chances of a successful trade. Now, let's dive into the first price action method for identifying support and resistance levels. First, let's talk about historical price levels, which we've already mentioned in our video on footprint strategies. Using a daily Nasdaq chart as an example, we'll break down what this actually means. We look for key swing highs and swing lows that appear on higher time frames like daily, weekly, or monthly charts. Here's how they form. The price reaches a high, then pulls back, creates a swing low, and eventually moves back up. For example, let's mark 5 swing highs on our chart. Once you get the hang of spotting important historical levels, you'll have a solid set of support and resistance zones to work with. The price tends to revisit these areas because there's liquidity above and below them, stop-loss orders from traders who previously entered positions around these levels. We'll use the horizontal ray drawing object and turn on the magnet feature. This will make the line snap automatically to swing highs and swing lows. Let's mark a few key levels and go over some possible trade setups. At first glance, it might look like the price ignored this level and just passed it. But if you take a closer look, this candle is actually positive. It's not green, but as we mentioned in previous videos, it closed above 50% of its height. If you had entered at the candle's close and placed a stop loss below its low, you could have caught a massive move here. It's a textbook trade. The next level played out beautifully as well. We got a strong breakout candle, though it didn't quite reach the very top, so it didn't meet the conditions for a reversal. Even so, there was still an opportunity to enter, for example, on the breakout of this high. Even at this point you could already see that the market was pushing to continue higher. The next levels worked perfectly for breakouts. The green candle could have signaled a flip, but it didn't fully establish itself above the support level. So we waited and then saw another strong breakout candle. At this point, we could have entered a short at the candle's close, with a stop loss above the high. As you can see, the trade would have easily hit the standard 2:1 target. Meanwhile, there was another trade opportunity here because the price reacted differently to this level. The breakout happened, and at the same time, there was a chance to trade the flip. Later, we got another breakout candle, but this time, it failed to continue higher. In this case, there wouldn't have been a solid trade setup, since we would have placed a stop loss here and entered a short following flip rules. Although further we can see that the candles reacted to the level again, it's better to stick to the strategy of entering the trade on the first touch. Another way of plotting historical levels is significant close because the market very often likes to react to those as well. For example, the close of the month, quarter, or year. I'll look back in history to where the 2023 close was here. This is the last candle of 2023. I'll draw the line again. You'll notice that there were level reactions here. There were negative candles, but eventually there was a breakthrough. And the price continued up quite strongly. Now I'm going to draw the close of last year, that's 2024. I'm going to use the horizontal ray again, and here we have a close of 2024. Let's see if it was tradable. You can see flip here and it did continue up quite nicely. And then we have another breakout candle and that's this one. You can see that would easily trade out again. Another breakout candle here probably wouldn't give us a 2:1 trade. There was a breakout down here, a continuation up and then no reaction to the level. However, plot the 21236 level on your Nasdaq chart and watch for more and more reactions as price returns there. The close of the year will be in effect all this year. On lower time frames, reactions are to be expected there. The second method is using levels based on the fair value gap, FVG. Here, we have a 30-minute Nasdaq chart. A fair value gap is a spot on the chart where, simply put, price has only moved once. For example, this candle forms an FVG. It starts at the high of the previous candle and ends at the low of the next candle. The price often retraces to these gaps, and we can already see that the wick of the green candle in the uptrend attempted to do just that. Now, let's look at the trading opportunities this formation presents. We'll mark the fair value gap using a drawing object, excluding the part that has already been covered by the wick. You can see how the price later returned precisely to the FVG and bounced off it, acting as a resistance level. The price reacted quickly to the next fair value gap. Let's mark it. The candles entered the gap and then continued moving upward. We could place the stop loss at the low of the green candle or below the FVG area, since the market will likely want to fill this space. Then, once the first positive candle closed, our green one again, we could have entered a trade with a 2-to-1 risk-to-reward ratio. Since the uptrend is dominant, we can look for more long entry opportunities using FVGs. For example, right here, we saw a strong reaction to a small FVG. The price tapped the key area with its wick and then closed positive, creating an opportunity to enter based on an order block. We were expecting a long setup since we had already seen a series of higher highs and higher lows, and in the end, this would have been a great trade. You'd be right to call this a pullback. Trading FVGs is similar to trading a flip, where the price retraces to a level from the opposite side. Now, we've switched from the 30-minute Nasdaq chart to the 5-minute chart. It's always a good idea to identify key support and resistance levels on higher time frames before switching to a lower time frame for an entry. This approach helps refine the entry point. So, we've identified a fair value gap and see that a candle has already closed, slightly breaking through the zone. I suspect it didn't close above 50% of its height. Let's check. It's just one tick below the 50% mark. We need to wait for the next positive candle before entering a trade. We can enter the trade at the close of this green candle, as it has finally closed above 50% of its height. This is the simplest confirmation within the smart money concept. For our stop loss, we have a few options. Placing it below this candle, under the current swing low, or beneath the fair value gap, as the price could still retrace into that area. The stop loss is set at 98 ticks, so we'll aim for a target of 196 ticks. And the target has just been hit. The next methods for identifying key levels come from the smart money concept: order blocks and breaker blocks. Like FVGs, they create a reaction zone for support or resistance. We covered these concepts in the first part of the Smart Money series. Here's a quick recap. An order block is the last positive candle in an uptrend before a swing high or the last negative candle in a downtrend before a swing low. The candle we've marked as an order block positive because it closes above 50% of its height. This is the current chart of the British pound, and you can see how the price reacted to the lower order block. Once again, this could have been a solid trade entry. It's always a good idea to use multiple time frames. For example, if I'm identifying order blocks on a 30-minute chart, a more precise entry could be found on a 5-minute chart. So, let's take a closer look. Here, we can see that the red candle tapped into the order block, and the next positive candle was green. This would have been a good entry opportunity at the candle's close, with a stop loss placed below the swing low. A breaker block is a candle that the price initially ignored but can still be traded like a flip level, or the price returns to the zone after breaking through it. For example, the order block formed by the last positive candle here turned into a breaker block when the green candles broke through it with ease. However, later, the price reacted to this level as if it was resistance. If you want to dive deeper into trading with order blocks and breaker blocks, we'll leave a link to a video in the suggestions. The last two ways to identify support and resistance levels using price action are round numbers and discretionary levels. These rely heavily on market psychology and intuition, which is why we've saved them for last. Let's begin with discretionary levels, which are based on areas where the price has frequently reacted in the past. We'll use a horizontal line again, but this time without the magnet tool. we're visually identifying the level where the price has reacted most often. Let's draw a horizontal line on the daily chart and mark the areas where the price has reacted multiple times. For example, here we can see several reactions. To make it easier, we'll highlight several levels and mark the one that stands out in yellow. Then, we'll check how the price reacted to that level on a lower time frame. On the 30-minute chart, there were quite a few interesting reactions. When the price approached the level from below, I looked for the first candle in the expected direction. Just below the level, there was a range. On the same line, there was a breakout, as well as a previous gap. Looking further, we saw more ranges on the line below the yellow one, and there was another gap at the yellow level. Of course, we should approach these lines with some skepticism. We were just looking for the middle ground between areas where we had seen some activity. The same goes for round numbers. This is the simplest method based on psychology. Numbers ending in zeros are naturally seen as significant milestones. People naturally tend to round numbers, which causes traders to place their orders around these levels, creating liquidity clusters. Let's take a look at an example. Here's the daily Nasdaq chart, with 3 price levels marked at 21,000, 20,000 and 19,000. You can see how the price reacted to these levels. The first reaction was at the 19,000 level, where we faced resistance, but this level turned out to be weak. Then, we had a strong breakout candle, long and convincing. This would have been a good spot to go long at the close of that candle. The next candle represents the third type of trade, flip. The candle was above the resistance level and returned to the level from the other side, turning it into support. We'd wait for a pullback to that broken resistance, now acting as support. The easiest trigger to enter would be the first candle that moves in the right direction. It doesn't necessarily have to be green, but it should be positive, like this one. We'd enter here with a stop loss below the low, and the trade would work out. Let's move on. Here, we see another breakout, but the new candle didn't hold its low. A gap formed, and the price was eager to come back and fill it, so a long position wouldn't work here. Moving forward, the price didn't quite reach the 21,000 level by just a few ticks, but we got a strong reaction. At this point, the downward move could have been traded. Looking further, the downtrend continued as the candle was below the support level, turning that support into resistance. This is where the price returned to the resistance from below. Let's wait for the first negative candle. Here it is. This is where we could open a short position. Afterward, a fair value gap formed, indicating strong interest in trading the downtrend. If we look further, we see another reaction at the 19,000 level. If we're waiting for the first candle to move in the right direction, this is the one. Here, we can enter a long position with a stop loss below the low of this candle or just below the swing low. Our target would be this level. Actually, this is another flip, a breakout of a key historical low, which we mentioned earlier. The price broke through here, and now we're coming back to the level from below, continuing the downward move. A long position here would be the right call in a flip trade. As you can see, using round numbers to build support and resistance is the simplest method, but these levels can often be weak. That said, there were quite a few reactions on the daily time frame. A 4-hour time frame could work just as well. Thanks for watching. We hope some of these techniques will suit your trading style. See you in the next video.